Good afternoon, everyone. I hope you're doing well. This is Thursday afternoon, October 27th. I have been on the road a lot in the last 2 weeks, and so I'm kind of digging through emails and answering phone calls and other kinds of things. I spoke 7-hour presentations for a church in College Station. It was very wonderful. Lots of young college kids and young couples that went to school there, and that was quite enjoyable. But 3 days after that, Shelby and Jeremy and I and their wives took off to Mexico for our annual conference, and we were there for 4 days and lots of talking and visiting. And so I come back this morning and I have about 10,000 emails and 100 phone calls, and so I'm digging through all of them. But I learned a lot. So we had some top economists there. This was a group of about 150 people. About 50 of them owned companies like the Oak Financial Group. But there were economists from all over the world there, and real estate people and people in the investment world. And it's a good time to sit in large meetings and one-on-one, having coffee or Coke together and just getting to know one another. And so I wanted, while this was fresh on my mind, to go over some things with you guys, and hopefully it will be of benefit to you. I want to start by showing you where we have been and go over a few things with you. This is year-to-date on the S&P 500, the black line here, and the NASDAQ. I do this because of two things. First off, I want to show you percentages over here. So what I want to show you is to go back about the last 5 or 6 videos that I have done. We reached a point down here in June time period, late May up into June, and I said to you that if the markets did not hold here, we were going to go 20% cash. And we did go 20% cash in this time period. Virtually all of our advisory accounts, we have been in 20% cash for a while. The market made a nice run up. It comes back and hits a bottom. And the bottom was on the 16th and 17th of June. That number, if you were to just pull up a chart of the S&P 500, is 3666 on the S&P. We had a pretty nice run, about a 10% move up, and you can see right here we're down year to date around 19%. This run brought us halfway back. And this was because companies were scared to death of their earnings. So they lowballed their earnings numbers. When the earnings came out for this quarter, we are just beginning the next quarter, and you're starting to see this here as well. What you see here is 93% of all companies made more money than they thought they were going to make. And that's what caused this run up to happen. The Federal Reserve hikes another 75 basis points. And just to explain for a moment, the only job the Jerome Powell and Company, what we call the Federal Reserve, is about maintaining stable money. When inflation gets up to 8 or 9%, that is unsustainable, and you start seeing all kind of industries falling apart. I would say the real estate industry will be hit pretty early, and in fact it already is. New housing starts are down 20% last month, 15% the month before. That's a third of all new houses that were going to be built over this country. They're backing off. People looking to buy a house, and most first-time home buyers, it's about a monthly payment. In 6 months' time, we went from a 3.5% mortgage rate to 7%. On a house that's a $300,000 house, that's about $1,000 to $1,200 a month increase in monthly payment. Now, that's really what raising interest rates is all about. The only way the Federal Reserve has to control inflation is to slow the economy down, and that comes with problems like layoffs and other kinds of things. So the market came up and topped basically here, and it sold off again, and guess where it sold off to? Exactly the low point that we were back on June 17th. So you can see several days here and across the board how many times this hit. This is, we've had about roughly 100 companies of the S&P 500. That's the 500 biggest companies in America. About a fifth of them have already announced their earnings, and the earnings have been better than expected, and that's why you're seeing another little piece coming back up in here. This number right along here may or may not hold, and there seems to be a consensus that if we break below this, it will not be for a period of time, for any long period of time. Your portfolios have been in 20% cash literally from this time period right in here. If we, and I'm discussing this with everybody that I respect and trust, to determine whether we go to 30% cash or we remain at 20%. So I'm watching on a regular basis to see where we are in this process. Let me look at my notes for just a moment. The great challenge that you all have had, and because you've had it, I have too, is our normal 60-40 or 50% stock, 50% bond portfolios have fallen absolutely apart because bonds have gotten hit just as hard as the stock market, and we've talked about that quite a number of times. The reason why bonds drop in price is simply this. If I had a bond that pays me 4% and that bond is worth $100, but you can go next door and buy a bond for $100 that pays 5%. My bond's not worth $100 anymore. It's worth $80 or $85. That's why when you see interest rates coming up this fast, there is really distortion and disruption in the bond markets. And I spend a lot of time talking with bond traders in the last several days about where we are. But what I would say to you is this. I said, probably have been saying for 6 months or more now, if inflation is going to be with us for a while, we will be moving more into real estate. Real estate is a proxy like a bond, meaning it'll pay you a 4.5 or 5 or 5.5% dividend. Those of you that are taking money out monthly, this becomes challenging because we're eating into principal because we're not making money and we're paying out your monthly income. I need something that is at least going to pay me 4.5 to 5.5%. which maintains the monthly money that you guys are currently pulling out, the ones of you that are taking systematic withdrawals. So in addition to that, you get appreciation. When you have inflation like we have now, 8.2 to 8.3%, real estate will increase in value. So I will be having conversations with you guys and probably sending out paperwork to a good number of you, and we will be moving money from cash into real estate. All of this real estate, I expect to make something between a 10 to 15% total return, but to pay out roughly a 5%, sometimes 5.5% dividend. Many of you have Blue Rock. That's one of my favorites. Some of you have a few other accounts. Hines would be one of those, and several others, Blackstone, BlackRock. But that's where I'm looking at heading because of what we talked about before. If inflation was only going to be for 3, 4, 6 months, 8 months, I would not have seriously disrupted the allocations that you guys were already in. I'm very pleased with the companies and with the research analysts behind the funds that we have, but this is beyond their control. This is something the Federal Reserve was very, very slow coming to the table. They kept saying to us, well, we don't think there is any inflation. And then they said for another 6 months, well, it's transitory, meaning it's going to go away. Now we're sitting into close to a year of 8+% inflation, and all of these rate hikes, the rate hikes lag. I mean, you don't see immediate results. What you do see is when people stop buying houses and they stop adding on and they stop traveling and all kinds of other things. So that's what's causing us to move more into real estate. I need to get your the amount of money that you had in your accounts back pretty close as quickly as possible, and that's the logical way from all the smart people that I talk to. So be looking for, I will be having conversations with you privately, a Zoom call, either a phone call, but we're going to be moving more pieces of money into real estate between now and the end of the year. We are expecting another 75 basis points, or 0.75%, in November, and possibly another one in December. Now that is a tremendous increase in what the Federal Reserve is charging, but they feel like they have to get on top of inflation. Why have they been so aggressive? Because they were 2 years late. This should have happened, and people were calling for it back in the once we got through the pandemic in the fall of 2020. People were really crying that the Federal Reserve needed to start raising rates because we pumped $7 trillion into the economy. And that money doesn't vaporize, it gets spent somehow. It might be on groceries or it might be on a new boat. But all $7 trillion of that money got spent. We still have supply chain problems. You can drive by your local car dealership and look at how few cars are sitting in the parking lot. So we still have serious supply chain problems, and we've got way too much money chasing too few goods. And that's fundamentally what causes the inflation. I think inflation will be around probably another, I think we will probably go from 8% to 5% in the next 12 months. But it's going to take a while to drive this kind of inflation out. It, quite frankly, will take the supply chain being fixed. So people are producing plywood, and they're producing lumber, and they're building cars, and they're building washing machines and refrigerators. That really is what's going to solve the supply chain problem, that and truckers, and primarily that's what will cause inflation to drop. Appreciate you listening to me. I would say to you one last thing. We will be sending out information on this, but we are going to have our 20th anniversary dinner on December the 3rd, the evening of December the 3rd. And that will be from about 5 to 7:30. I've got a number of friends that are speakers coming in. Those of you that are in Tyler and in the Hill Country, we probably will do some sort of joint dinner there. But we started the Oak Financial Group just over 20 years ago. I've been in the business about 29 years, but so this is our 20th anniversary. Some of you probably have called in and talked with my granddaughter, Darcy. So she is the latest addition to the Oak Financial Group. There are 19 of us now. You can you go to our website and take a look at the photo. You will see everyone but her, and we're trying to figure out how to Photoshop her into that, so she will be in the picture. Thank you for listening to me. If you have any phone calls or calls, I look forward to visiting with you. God bless. Thank you.
Awesome. Okay.